Nation over empire, the U.S. pivot and its global ripples. The re-election of Donald Trump marks a watershed moment in modern U.S. history, signaling a decisive shift in the nation's priorities. This year's annual outlook explores the profound implications of America's inward turn, encapsulated in the choice of nation over empire. With this pivotal electoral decision, Americans have opted to prioritize domestic stability and national interests over the complex responsibilities of sustaining global hegemony. The Trump administration's renewed focus on domestic production, re-industrialization, and trade protectionism reflects a recalibration of America's role in the world from enforcer of global order to a nation intent on rebuilding from within. Yet such a choice comes with ripples across markets, regions, and industries. From financial systems adjusting to America First fiscal and trade policies, to geopolitical uncertainties in Europe, Asia, and the Middle East, the pivot is creating a new global equilibrium. This retreat from the imperial project could offer opportunities for national economic resilience, but also challenges in maintaining influence and stability in key regions. The 2025 annual outlook will delve into these dynamics, highlighting how this shift is reshaping everything from supply chains to investment strategies. The report aims to provide investors with actionable insights into navigating the emerging world order, where the American empire takes a step back, allowing markets and nations to recalibrate their roles. As we chart the course of this redefined American identity, the interplay between national priorities and global responsibilities will undoubtedly shape the years ahead. Welcome to a new era of strategic pragmatism, where the United States focuses inward to secure its future, while the rest of the world adjusts to its new role on the center stage. America's steady exceptionalism. American exceptionalism has long been a defining narrative of the nation's global role. In recent years, this has been underscored by its leadership in the AI revolution. As highlighted in the AI Economic Impact Index, the United States continues to dominate innovation, diffusion, and adaptation of AI technologies. Indeed, this leadership translates to tangible global influence and an innovative ecosystem that remains unmatched. It reinforces the idea that AI is not only reshaping industries, but also acting as a core pillar of U.S. economic power. Of course, the story of American exceptionalism is also evident in the financial markets. The S&P 500 continued its dominance as U.S. growth stocks outperformed their global peers for most of 2024. This table highlights the shifting landscape of corporate dominance over decades, showing that in the current era, U.S. tech firms dominate the list of the world's largest companies. America's unique ability to regenerate and dominate new economic paradigms, from the post-war industrial boom to the current AI-driven innovation cycle, speaks to its exceptionalism. The relative performance of U.S. assets like equities, treasuries, and the U.S. dollar in 2024 exemplifies this resilience. However, exceptionalism is not without challenges and trade-offs. As this chart shows, rising income inequality and the concentration of wealth in dominant firms pose risks to social mobility, potentially threatening the cohesion that underpins the nation's innovative capacity. Current conditions in the United States are a fertile breeding ground for economic populism. As this graph shows, with the country now running twin deficits greater than 10% of GDP, how long before the bond vigilantes awaken and demand fiscal discipline? Yes, the US dollar is the world's reserve currency, and investors must hold treasuries, whether they like to or not. But even the mighty greenback is subject to debt dynamics. Only the day, and perhaps magnitude of reckoning, has been stayed. Will Donald Trump end U.S. economic outperformance? Well, we would argue that Trump's policies could slightly hinder U.S. GDP growth over the next few years, noting three key risks. First, A tilt toward isolationist policies might curtail economic benefits derived from trade and immigration. Second, Trump's inability to address the growing fiscal deficit could heighten medium-term fiscal vulnerabilities. And third, his potential dismantling of institutional frameworks could undermine the economic foundations that have supported the U.S.'s rise. However, his re-election is unlikely to threaten the U.S.'s position as the world's leading economy in the long term. Importantly, deregulation initiatives could also support economic growth, though their practical impact may be limited. So, looking beyond the immediate future, the long-term outlook for the U.S. economy remains robust. Structural advantages provide a resilient foundation. These factors would require decades to erode significantly, even under adverse policy conditions. Emerging technologies, particularly AI, also play to America's strengths, reinforcing its global leadership. Thus, we anticipate the U.S. will maintain its status as the largest, wealthiest, and most influential economy for the foreseeable future. However, economic outperformance does not guarantee continued stock market dominance. In the near term, U.S. equities may continue to outpace global markets. In fact, we expect so, but supported by these relatively strong growth and tempered inflation fears. But the AI-driven stock market enthusiasm could sustain the current bubble for a while longer. But beyond this boom, we are less certain. The 2025 Global Macroeconomic Forecast. The global macroeconomic outlook reflects a complex environment in 2025, shaped by geopolitical risks, policy shifts, and innovation-driven growth. Overall, as this graph shows, we expect global growth to moderate to approximately 2.8%, reflecting policy tightening and geopolitical tensions. For example, U.S. tariffs and reduced global trade integration could weigh on growth. The upcoming trade war, or even just tariff threats, pose significant downside risk globally, particularly for Asia. And while traditional sectors slow, innovation-driven industries, particularly AI, remain a bright spot globally, continuing to support select economies. In the United States, our proprietary Insigneo Forefront Recessionary Indicator remains subdued, indicating only a 12% chance of a U.S. recession over the next 6 months, suggesting an environment where it is still prudent to maintain risk in portfolios. Over a 12-month horizon, the environment becomes murkier as labor demand concerns remain worrisome and on a deteriorating path. But back to the previous graph, for 2025, we expect real GDP to slow but remain robust at 2.1% for the United States, above the trend level of growth, primarily driven by fiscal policies, strong consumer spending, and business investment in AI and equipment. Now, risks include higher rates, higher tariffs, policy uncertainty, and restrictive immigration policies. The Federal Reserve should continue cutting rates, with the federal funds rate settling between 3.5% and 3.25%. Fiscal stimulus, including tax cuts and deregulation, should provide a short-term boost, and we expect core PCE inflation to settle around 2.3 to 2.4% by year-end, with some upward pressure potentially from tariffs and wage growth. Now, for the world's second largest economy, we project China's real GDP growth to decelerate further to 4.1% from this year's pace of 4.8%, hampered by U.S. tariffs and domestic policy constraints that prevent the government from acting aggressively. Indeed, structural issues such as weak consumption and housing market correction persist. We continue to expect limited fiscal and monetary measures, insufficient to offset trade disruptions. The risks of Japanification for China are mounting. Finally, in the Eurozone, it should grow at 0.9%, constrained by weak domestic demand and trade headwinds as well. With inflation pressures easing, we expect more acute monetary policy easing, but persistent structural inefficiencies and reliance on exports should keep growth subdued. As we have stated in the past, Europe's economic model is broken, and it needs more than just tinkering. Global market outlook. We expect equity markets to deliver moderate returns throughout the year, driven by strong earnings growth in sectors like AI and industrial innovation. That said, the biggest risk to the equity market remains higher yields. U.S. equity markets should maintain their leadership as Trump 2.0 policies drive both economic growth and interest rates higher, which we believe will support equities in 2025. Earnings growth, not multiple expansion, will be the key driver, with the S&P 500 potentially reaching 6,300. However, high valuations indicate fragility, with significant market volatility projected despite likely positive annual returns. We also expect a rotation in leadership, favoring value over growth, small over large caps, and cyclical over defensive sectors. The Magnificent Seven may still perform well, but we see their dominance waning as earnings growth broadens. AI investment will shift focus from infrastructure to applications and early adopters. Banks, utilities, autos, and industrials would benefit from deregulation and protectionism, while semiconductors face headwinds. Diversified banks and small caps should gain from rebounding capital markets activity. Now, Europe and China should underperform due to weaker economic fundamentals, geopolitical risks, and various unresolved structural challenges. China's equity market recovery depends on fiscal stimulus and domestic policy improvements, but risks from U.S. tariffs persist. Meanwhile, the Eurozone remains challenged by weak domestic demand, sluggish earnings growth, and political uncertainty. However, a barbell strategy balancing U.S. equities with selective exposure to certain undervalued and resilient developed markets like Japan is prudent. Specifically, Japanese equities are expected to benefit from corporate reforms, rising real wages, and robust share buybacks, and we expect the TOPIX to deliver strong returns. In fixed income markets, we expect approximately 2 to 3 more rate cuts by the Federal Reserve this year, slightly more than the current expectations of only 40 basis points. Thus, treasuries remain attractive for risk-averse investors. We also expect a benign, if unspectacular, year for investment-grade bonds, while credit spreads remain uninspiring in high-yield markets. This table reflects the expected performance of U.S. rates under various Fed scenarios over the next 12 months. We favor long-duration bonds as rate cuts lower yields, though credit spreads may widen in riskier segments. While emerging market debt offers attractive yield opportunities, it faces material risks from a strong U.S. dollar and geopolitical tensions. Select markets like ASEAN, South Africa, and parts of Latin America offer relative resilience. Now, diversification across asset classes, including alternatives, is critical to managing market volatility, particularly in today's environment. We prefer gold over industrial metals and oil due to geopolitical risks and economic uncertainty. However, as this graph shows you, it is quite expensive relative to both oil and wages. But ongoing and increasing purchases by central banks around the world give us some comfort that the debasement and reserve diversification trade will continue and should support gold prices. For digital assets like Bitcoin, key drivers of adoption include increasing institutional interest, technological advancements, and heightened consumer awareness. Potential enhancements may be coming down the line that improve transaction speed and reduce costs. They are also compatible with other emerging technologies such as smart contracts and decentralized finance systems. Obviously, Bitcoin's volatility is a significant risk for both retail and institutional investors, and its store of value properties remain aspirational. However, we anticipate the continued evolution of the Bitcoin ecosystem driven by regulatory clarity, technological innovation, and broader adoption. We anticipate that Bitcoin will hit an all-time high by the middle of this year and achieve a $148,000 target by year-end. In our view, no more than a 2% allocation to digital assets is warranted at this time. In addition, we expect continued interest in real estate and private assets as monetary easing stabilizes the macroeconomic environment. Private equity faces valuation pressures, but newer vintages focusing on cash flow and cost discipline remain attractive. And finally, the US dollar should remain strong in the short term, but could peak mid-2025. Longer-term investors should focus on rebalancing portfolios to strategic asset allocation targets and maximizing diversification among stocks, bonds, real estate, hedge funds, and private illiquid investments. As this table shows, expected annualized returns for various assets over the next 10 to 15 years based on a 2.5% inflation scenario. It suggests that financial asset performance over the next decade should be less robust than it was over the previous one. France and Germany, the aftermath of the budget debacle. Last year witnessed major political upheavals globally, and Europe was no exception. The two biggest economies of the European Union have been in the eye of the storm amid government collapses, budget deficits that threaten fiscal stability, and the rise of far-right leaning alternatives that were not considered probable a couple of years ago. Thus, we decided to zoom in on both situations, hoping to assess the fiscal and fixed income implications of current developments while observing how the nation over empire move previously observed in the US translates into the French national rally and the German AfD, disrupting the European political landscape. France has faced a challenging environment since June 2024, when President Emmanuel Macron dissolved the National Assembly and called early elections. The election outcome was a divided lower house, almost evenly split between three conflicting blocs: the leftist New Popular Front Alliance, Marine Le Pen's far-right National Rally, and a smaller group of centrists that supported the president. Against this backdrop, in early December, the French government faced a vote of no confidence that led to Prime Minister Michel Barnier's resignation after he used a constitutional tool to bypass the voting on the 2025 budget, which did not sit well with the opposition. Newly appointed Prime Minister François Bayrou has reformed a new government by announcing his new cabinet members while also juggling with establishing a new 2025 budget, which he aims to present by mid-February. In the meantime, a special law will be enacted to roll over the 2024 budget into the initial months of 2025, with this law only permitting vital spending necessary to fund essential public expenditures. The importance of the 2025 budget has been increasing as France's fiscal situation has deteriorated and run afoul of EU targets. According to some estimates, France's 2025 budget deficit will be around 5.4% of GDP. Even if that figure is expected to be an improvement from 2024's deficit of 6.1, it is still non-EU compliant. As a reminder, the EU requires member states' debt to GDP ratio to be below 60% and their deficits to run below 3%. Once seen as the fiscal and economic powerhouse of the EU, Germany's current situation falls far short of its reputation. The current government crisis led to the SPD-led government coalition losing a confidence vote and to snap elections that will be held in February of 2025. Additionally, the ruling coalition could not agree on a 2025 budget. Amid this situation, the discussions around its debt brake, better known as the Schuldenbremse, have gained relevance because of the brake's capacity to constrain Germany's fiscal flexibility and ability to respond to economic shocks. Essentially, the debt brake was implemented to limit Germany's structural annual deficit to 0.35% of GDP against a backdrop of recommendations from the OECD and the IMF that Germany needs to increase government spending and reskill its workforce. It is worth mentioning that in 2023, Germany's government budget deficit was 2.5% of GDP, and according to market forecasts, its budget deficit is expected to stand at 2.2%, 2%, and 1.8% of GDP for 2024, 2025, and 2026, respectively. Even if these figures are EU compliant, they would be far from the brake's more rigorous threshold. Moreover, the center-right CDU-CSU coalition leading the polls for the upcoming elections does not include a reform of the debt brake in its program. Rather, it proposes tax cuts and supply-side reforms aimed at eliminating unnecessary processes while increasing labor supply, investment, and maintaining the debt brake. On the other hand, while the SPD and the Greens favored demand-side stimulus, this coalition aims to reform the brake rule. Given the lack of agreement over the initially presented 2025 budget, Germany's finance ministry announced that the government's finances would be managed through a provisional budget until the new government outlines its own. This situation resembles what we previously highlighted in France, where the government can only disperse funds that are either already committed or needed to keep the country functioning. Meanwhile, the Alternative for Deutschland, the AfD party, the extreme right alternative currently second in the polls, also advocates for maintaining the debt brake. However, it proposes to reduce Germany's contributions to the EU and to examine current asylum policies. So what has been the market's reaction? Well, Germany recently announced it will reduce its debt sales by 13% in 2025. However, this plan presented by the German Finance Agency will be subject to change once the new administration takes office and adopts a potentially new budget. German fixed income digested the news of reduced issuance for 2025 positively, since a reduced government debt supply can imply a flatter sovereign curve. Nonetheless, it is worth stressing that German finance ministry officials do not expect a regular budget until the second half of 2025, and that potentially positive scenario is subject to change. In the case of France, uncertainty around the functioning of the new cabinet has been high, which is translated to the spread between the French and German debt to widen substantially since the government crisis began. Such high uncertainty and an inability to agree on a budget for 2025 are expected to remain a key feature of the French political landscape throughout the year. Moreover, this may take a toll on long-term French bonds, since current market expectations are penciling in a steeper sovereign curve in the first quarter that only continues to steepen throughout the year. This in turn may lead to wider spreads between German and French debt. In sum, considering that the political situation in both countries remains unresolved, we would stay on the sidelines in terms of holding either German or French sovereign bonds. We believe other European countries, such as Spain, currently offer a more benign fiscal scenario that, coupled with more attractive yields, could make for a more profitable alternative when looking for exposure to European fixed income. Latin America, a three-cushion billiards game. U.S. trade relations are crucial for Latin America, with nations such as Nicaragua and the Dominican Republic relying on the U.S. for over 50% of their exports. As shown in the following graph, most major economies in the region are engaged in a two-front trade dynamic with both the United States and China. For countries heavily exposed to China, the proposed 60% tariff on Chinese exports and the outcome of China's fiscal stimulus plan are critical. These factors will influence China's growth and its demand for commodities, which will in turn affect commodity exporter countries like Chile. Tariffs will create first and second order effects. First order effects are immediate price changes and supply chain disruptions, while second order effects are more long-term, including foreign exchange rate adjustments and inflation. For Latin America, second order effects are significant, given the region's reliance on exports to the US and China. The implementation of tariffs is expected to weaken local currencies as a way to offset higher product prices, eventually driving inflationary pressures across the region. Beyond economic consequences, tariffs will also shape the political landscape in Latin America over the next 2 years. Similar to what is happening in Mexico and Canada, the US may use tariffs as a tool to negotiate better trade deals. This will coincide with a number of key elections. Chile and Ecuador will hold presidential elections in 2025, and Colombia, Peru, and Brazil will follow in 2026. Now, Argentina and Brazil, a tale of two countries. Argentina and Brazil, two of the main economies of Latin America, are facing starkly different dynamics with the arrival of Trump 2.0 administration. Even if both countries made conscious efforts to improve their bilateral relationship, internal political forces have made the Brazil-US relationship a more complicated one. Amid the development of diplomatic challenges like the Russia-Ukraine war, Brazil and the United States have taken different approaches that have led Brazil to occupy a low-priority role for the U.S. Thus, Brazil has developed a closer relationship with China, to the extent that China represents 30% of Brazil's total trade. In contrast, the U.S. represents only 13%. Still, market analysts from Bloomberg forecast that the potential 20% tariffs the U.S. plans to impose on Brazil would mainly affect goods such as oil, metals, and transportation equipment. Moreover, the same Bloomberg analysts expect Brazil to raise its exports to the rest of the world to offset the effects of tariffs, even if the Lula administration cannot help exporters via manufacturing subsidies or by decreasing import taxes. Meanwhile, it should be noted that Brazil's exports are concentrated in commodities such as soy, iron ore, and oil. Since the U.S. also exports soy to China, Brazil could benefit from the increased tariffs that would be put in place once the new administration takes office, assuming China retaliates using Trump's first trade war as a baseline. Furthermore, the fact that the European Union and members of Mercosur reached a trade agreement that is expected to establish one of the largest trade zones in the world, while becoming the EU's biggest trade agreement, needs to be monitored. Even if this could be viewed positively, it is worth noting that the European Parliament still has to ratify the agreement, which may take some time. On the other spectrum, Argentina represents a different set of challenges and opportunities. Ever since President Milei took office, he has made it a clear objective to become the newest ally of President Trump in LATAM without compromising Argentina's business relationship with China. Milei's idea of having close ties to the U.S. aims to receive President Trump's support to negotiate a new deal with the IMF. Last year, the IMF announced it would review Argentina's current aid program in January 25. Moreover, Milei stated he would try to negotiate a free trade agreement with the United States, considering that both nations signed a trade and investment framework agreement in 2016. However, what started as a pragmatic stance with China has evolved into a warmer relationship, given China's interest in some of the commodities that Argentina produces, and the pressing need of the Milei administration to get fresh funding through an extension of its swap line of $5 billion through 2026. It is worth noting that China is Argentina's second largest trading partner after Brazil, accounting for 14% of Argentina's total trade. Quote, "On January 20th, as one of my many first executive orders, I will sign all necessary documents to charge Mexico and Canada a 25% tariff on all products coming into the United States." President Trump posted this message late last year, announcing his intention to use tariffs as a tool to enforce immigration. The following day, Mexican President Claudia Sheinbaum replied that, quote, "Neither threats nor tariffs will solve the issue of migration or drug consumption. Imposing one tariff would mean another comes in response, continuing like this until we put shared companies at risk." This rhetoric sounds like the opening salvos of a trade war, using the ammunition of tariffs. President Trump is likely to openly use tariffs as a negotiating tool and will stand by his word to implement these if other parties are not willing to negotiate. At the same time, President Sheinbaum is likely to openly resist tariffs, using her stance to win political points both within the government and with the Mexican people. At first glance, this situation would appear to be a real-life, trade-based Mexican standoff. Beneath the surface, however, things are likely to be different. In 2023, Mexico became the United States' largest trading partner, sending $475 billion worth of exports to the U.S. that year alone, breaking China's 16-year hold of that title. According to the American Society of Council of the Americas, nearly 80% of Mexico's exports went to the United States in 2022. At the same time, according to the U.S. Department of State, the United States is Mexico's largest source of foreign direct investment. Equally important to the United States, Mexico is the second largest destination for U.S. exports. If tariffs were to be implemented as stated, their effects would be felt on both sides of the border. Mexico's northern states of Nuevo León, Coahuila, and Chihuahua would be negatively impacted by the reduction in nearshoring demand for technology-oriented goods. At the same time, in the United States, Texas, New Mexico, and California would be negatively impacted from decreased trade flowing into these states. However, the reality is that the United States and Mexico depend on each other for more than just commerce. As we traveled throughout Mexico last year, we were asked numerous times the following question: do you think that the United States will abandon Mexico? Our answer was, and continues to be, no, we don't think so. Commerce is important, but so is geopolitics. China is knocking on the door of many Latin American countries, attempting to expand its influence in the region. Given the historically strong ties between both countries, as well as Mexico's geographical proximity to the US, we do not believe that the US will abandon Mexico and risk allowing China to gain influence over its closest neighbor. Our view is further reinforced by President Trump's pick for US Ambassador to Mexico, Ambassador Ron Johnson, a proven individual with extensive experience in diplomatic and military affairs across Latin America. Now, the best of the rest. While Chile's economy is closely linked with copper prices, with Bloomberg reporting that nearly 40% of Chilean peso volatility is explained by copper price movements. As Chinese tariffs are assessed in early 2025, the Chilean peso is expected to weaken. However, the peso is expected to find some relief buoyed by China's fiscal stimulus plans. Chilean political uncertainty leading up to the presidential election will add some risk premium to the FX, with markets anticipating a rally if a market-friendly candidate prevails. Polls show conservative Mate and former President Bachelet leading the race. Colombia, Peru, and Ecuador are less exposed to tariffs, as their exports primarily consist of commodities like oil and minerals, which are less vulnerable to trade barriers and can be redirected if necessary. However, Colombia faces challenges as its interest rates converge with those of the United States, leaving little room for cuts. Once Colombia exhausts its ability to reduce rates, weak fundamentals will put pressure on the exchange rate. In Peru, political uncertainty persists as President Dina Boluarte potentially faces impeachment after July 2025. Ecuador's February 2025 elections will also be crucial, with President Noboa slightly leading leftist candidate Gonzalez. A Noboa victory would improve Ecuador's relationship with the US and increase market access. In Central America, migration policies represent a greater risk. For example, almost 12% of El Salvador's population lives in the United States without authorization, and any rise in deportations could hurt domestic economies. In Uruguay, the new government's expansionary fiscal and monetary policies are expected to intensify inflation, adding further pressure to an already fragile economy. Much as in the first Trump administration, it is likely that the current situation involving a trade war between the US and LATAM will be resolved at the negotiating table. However, both parties must be willing to negotiate to reach a mutually beneficial outcome. As was said in Game of Thrones, no one can survive in this world without help. No one. A chain reaction 2.0. As discussed in our Q2 2024 quarterly call, nuclear power has been poised for a renaissance, awaiting the right catalyst. The Russian-Ukraine war provided that spark, while artificial intelligence has ignited the flames. AI is expected to drive energy infrastructure growth in the years ahead. With the countries striving for green economies, nuclear power stands out as a more efficient alternative to traditional renewable energy sources, offering low carbon emissions, high energy density, and a small land footprint. A single nuclear power plant can generate as much energy as 3 large wind or solar farms. Since the COP28 summit in December of 2023, over 20 nations, including the United States, have pledged to triple global nuclear capacity by 2050. Using 2020 as the baseline, this goal requires adding 740 gigawatts in less than 3 decades, a remarkable feat given it took 70 years to build the current 390 gigawatts. Achieving this will demand significant acceleration in financing, development, and capital expenditures. In this context, nuclear power has become a global race, with China leading the way. China's dominance in nuclear development stems from its ability to construct plants in an average of 7 years, far outpacing Europe's 10-year average and the United States' 15-year timeline. For context, the US has completed only one nuclear plant in 30 years, the Debacle facility in Georgia, which faced a 7-year delay and $17 billion in cost overruns. China's edge lies in extensive expertise, reliance on state-owned enterprises, low-cost financing, and affordable labor. Additionally, China is advancing toward fast reactor technology, a fourth-generation innovation that recycles uranium and plutonium as fresh fuel. This breakthrough could significantly reduce nuclear waste, addressing one of the primary safety concerns of nuclear power. And while the US has been slow to progress, hyperscalers like Amazon, Microsoft, Google, Oracle, and Meta are now advocating for nuclear energy as part of their zero-emission targets. Due to the long timelines required to build traditional nuclear plants, these companies are focusing on a developing technology called small modular reactors, which have a capacity of up to 300 megawatts, about a third of traditional reactors. SMRs are versatile, faster to deploy, and expected to become commercially viable by 2028. The Asia-Pacific region is leading SMR development, positioning its companies to dominate the supply chain for US projects. Other initiatives include nuclear fusion, which, unlike traditional reactors, generates energy by pushing atoms together. This process uses light gaseous elements as fuel, reducing costs and the risk of meltdowns. Microsoft recently signed a power purchase agreement with Helion Energy, a fusion startup backed by OpenAI's director Sam Altman. While skepticism remains about the pace of advancements in this field, Helion aims to commercialize fusion energy by 2028. On the commodity side, uranium prices have recovered from 2016 lows, but remain below early 2000s peak. With AI driving demand, uranium consumption is projected to double by 2040. However, uranium requires enrichment to become usable fuel, a process dominated by a few companies. And Russia controls 44% of global enrichment capacity, followed by China at 10%. Recent US legislation restricting Russian-enriched uranium imports has boosted prices. While the long-term outlook for uranium remains bullish, short-term volatility will rely on geopolitical factors, particularly the resolution of the Russia-Ukraine conflict.